Hi, welcome to Quantist Investment. Today, I want to say something good about the long-term bonds, the U.S. long-term bonds, because I've been talking about or researching into the risk of the long-term bonds. But today, I found some good news. So, well, the motivation again is that the U.S. 10-year Treasury yield is holding above 4%, which is something I'm interested in buying more. So I went into studying the risk, and I found some conclusions that I want to briefly talk about. First one is U.S. long-term Treasury yields are at about 20 years high. I did a video on that. So technically, it is good. It is high. The bond price is low, so it's cheap. When something is cheap, we want to buy. The second point is the U.S. core PC is still above 4%. I think it's still too high. It's not a good sign that the Fed will lower rates. It's not even a sign of the ending of the rate hikes. So the second one, another one is the yield curve is badly inverted. So either way, if the Fed hikes more rates or the yield curve becomes normal, it may bring the long-term yields up, so that the price of the long-term bonds will lower, and we will lose money. So the study of today's ETFs are the following: the TLT, IF, and II. The TLT represents long-term bonds, while the IF and the II are their midterms. IEI is not short term, it's still above 3 years long. It's not so short. Then I use the tool, the calculator I built. We randomly select the investment starting inception date. First, we input the tax rate on dividends to 0 and give it a 252 days for investment duration. That's 1 day, 1 year. So there are 252 trading days. So we just do the auto run. We see the result that the IF have a 50% chance of beating the TLT. But something we are interested in is the TLT has a higher return, higher average return than the IF. Okay, so well, I don't want to do all the tools all the time during this video. I'll just brief it. Investing for 5 years, that's when I input, instead of 252 days, I input 252 times 5. The result is the IF has a 20% chance of winning. That means the TLT has an 80% chance of winning. And the magnitude of TLT winning is bigger. Investing for 10 years, it's even so. TLT has almost 100% of winning, of beating IEF. So the long-term bonds win when we hold longer. And the returns difference is bigger. TLT wins more when holding longer. The next comparisons between the IF and IEI, they have a similar results. So investing for 4 years, IEI wins for 40%. So IEF wins. IEF is the one. IEF is longer term, but IEF wins with a about 1% difference in average. 5 years, same thing, but IEF wins IEF had a chance of 92% chance of winning with a magnitude 1.3%. 10 years, same thing. IEF have a almost 100% chance of winning with a magnitude of bigger than 1%. It's a 1.4%. So I went ahead because I was interested. That was when the yield curve was inverted. I chose two time frames. The first one was 2019, June. One thing that's interesting is on the day of June 7th, 2019, the yield curve was very inverted. But 1 year later in 2020, June 8th, the yield curve became normal. It only took 1 year for the yield curve to become normal. So I chose the time frame from the days I talked about. I said so. TLT wins with a return double of the IF. Second time, 2007, same thing. It took 1 year for the yield curve to become normal. IEF and TLT have very similar trend. It doesn't mean that the yield curve, well, they have similarities that both during the both times when the yield curves were inverted, the Fed lowered rates to, I don't know, maybe zero. They just dropped rates during the time. So when the yield curve was inverted at the end, 2007 and 2019. 2020 and 2008. That's when the Fed lowered the rates. That's when the yield curve became normal. During rate hikes, 2022 is the closest days when we were experiencing the rate hikes. We see the TLT has a very bad return of negative 35. IEF negative 16.9. 2015, we see TLT won, but had a very bad fluctuation. 2004, same thing. So conclusion is under a normal yield curve situations, the long-term yield is higher than the shorter ones. So it makes sense that if you hold a long-term bonds with a higher yield and hold it until maturity, we will earn more money when we hold something that's lower yields, because the price fluctuation will not. We don't see the price fluctuation. We hold it until maturity, but we'll mentally see the price difference when we and buy and sell the bonds when it is not at maturity, when we don't hold it until maturity. So it makes sense that longer term bonds will give you a higher return during a normal curve situation. So the previous two times when the yield curves were inverted were in 2007 and 2019, and they were resolved not because the long-term yields increased, but the Fed dropped the rate for the short-term rates to drop. Then the yield curve becomes normal. So by the way, for the first point, that there's one situation that the short-term bond will win with higher yields. That's when the yield curve is inverted for longer. So imagine if shorter bonds for example, now the short-term yield is like 5%. You hold it for 10 years, for 10 years, it'll become a 10-year bond with a 5% yield instead of holding a 10-year bond with a 4% yield. In this situation, the short-term bonds will give you a better return. That's why we call a yield curve inverted situation, because it's not normal. When you invest long, you want a better return. So for the historical returns, we see normally, yes, holding longer term bonds will give you a better chance of winning the shorter ones. So I guess during the data I have, most times the yield curve is not inverted; it's normal. It's something that I'm looking into and give me some thought about what I want to put my money in. Thank you for watching. Bye bye.